want an exposure to a market or an
Everything they need in one place.
The world's foremost authority on individuals, advisors and institutions.
Hello and welcome to the Morningstar series, Ask the Expert. I'm Emma Wall and here with me today is Sean Port, Chief Investment Officer of Nutmeg. Hello, Sean.
Hello.
So Nutmeg blend passives in order to create portfolios for investors, low-cost portfolios. How exactly do you go about that? I mean, what's at the core of those portfolios?
Well, I think asset allocation is your primary decision as an investor, whether you're a retail private investor or whether you're an institution. So we really focused on risk as our sort of primary decider on how we're going to manage a portfolio, what blend of assets we're going to use. And of course, you generally are going to start with large cap equities. That's the US, obviously the UK, Europe and Japan, a very broad spread. And then we look to build and use bonds as a more of a stabilising element in portfolio to provide a degree of income. And then we look at other asset classes. What do they really add to the portfolio? Do they really enhance a basic portfolio? We always have to come back to basics and say, if you look at a straight large cap equity, government bond portfolio, how can you improve on it? And if you can't, why are you doing it?
Those sort of external extras are called satellite funds, aren't they, or satellite holdings, and they're where you have much smaller exposure to perhaps more risky things. I mean, obviously it's dependent on the individual's appetite for risk, but generally that's where things like emerging markets start to come in, isn't it?
Yes, emerging markets and small companies, whether that's in developed markets or emerging markets, other brands of fixed income such as emerging market debt or high yield. These are interesting things you can add to portfolio, but there are actually things that you should think about where you are in the cycle. Should you be owning high yield at this point in the cycle? Should you be owning small caps? These are things that are very much dependent on where you are in the market and the economic cycle. So you need to add these quite intelligently and think about what they're doing to your portfolio in terms of the risk and the potential reward.
Now, Nutmeg has become known and synonymous with passive investing, but there's nothing written in your company DNA to say that you're against actives 100%, are you? It's more about if those opportunities arise, then perhaps you'll look at active exposure.
Yes, absolutely. I think when we look at it, can we see active managers delivering and doing better than their costs? That's the fundamental problem. If you have quite high fees, whether it's an annual management charge or turnover costs, the manager has to beat those fees. And there's nothing to say that an active manager can't pick individually good companies. It's actually a lot of this fee drag that's the problem. So we focus on really driving down that fee. And if we can construct a very well diversified portfolio with something like 3,000 underlying holdings at a cost of about 0.15, 0.2% a year, it's very hard for an active fund to actually come out and beat that very low return. But actually, if we did see an asset class where we thought active managers would do consistently better on a reliable basis and over many time frames, not just over 5 years, but over relatively short time frames like a year, we may include that. So there's nothing written to say we won't ever include an active manager, but it has to be really valid. It has to add a lot to the portfolio and to beat what is quite a hard benchmark, really, really low costs and the asset class return in itself.
And property perhaps is one of those asset classes where the sort of investment that it is, we're talking about real bricks and mortar holdings here, lend themselves to something such as an investment trust, a closed-end portfolio, because of liquidity problems.
Yes, I think when you look at where active managers could deliver, it's in the less liquid asset classes. And I think you're probably at risk going in an open-ended structure. You're much better in a closed-ended structure, like you said, an investment trust, where they can actually physically manage those investment, and costs are very important in that when you transact a portfolio. So some asset classes, I think, are very much more suited to a closed-ended structure when there's a lot less liquidity.
But it is, at the end of the day, making sure that every holding has earned its place in your portfolio.
Absolutely, it has to pay for it.
Sean, thank you very much.
Pleasure.
This is Emma Wall for Morningstar. Thank you for watching.